Previously, foreign institutional investors were required to have sufficient funds in their accounts before placing a buy order. This had limited portfolio diversification as foreign investors had to wait for the proceeds from stock sales to be credited before executing subsequent purchase transactions. On October 1, State Securities Commission of Vietnam officially announced the issuance of Circular 68 by the Ministry of Finance. According to this circular, starting from November 2, foreign institutional investors will be allowed to place buy orders without the requirement of upfront funds. Securities companies will assess the payment risk of these investor groups to determine the minimum required margin when placing buy orders, as agreed upon by both parties. Foreign institutional investors placing buy orders must have sufficient funds in their accounts before the custodian member is required to transfer the funds to the custodian member's deposit account at the clearing bank. In case of insufficient funds, Vietnam Securities Depository and Clearing Corporation will transfer this payment obligation to the securities company. Securities companies will be allowed to transfer ownership outside the trading system or sell through negotiated deals on the trading system the securities that have been transferred to their proprietary accounts for foreign institutional investors that fail to make payments for purchased securities, as prescribed. To ensure the safety of payments for the trading activities of foreign institutional investors, the circular also imposes the limit for accepting buy orders, which is equal to the total amount that can be converted into cash but not exceeding the difference between twice the securities company's equity and the outstanding margin loan balance. Furthermore, to comply with the cross-ownership regulations, in addition to adhering to the mentioned order acceptance limit, securities companies are not allowed to accept buy orders for their own shares or for the shares of their parent companies. Additionally, the new circular also requires that securities companies must disclose information and report to the State Securities Commission and the Stock Exchange, as well as notify the listed company or the registered organization when the daily trading value reaches VND 50 million or more or the monthly trading value reaches VND 200 million or more, calculated at par value, including cases of transferring ownership outside the trading system within 24 hours. So, how will this circular affect the stock market? The Vietnamese stock market has witnessed a significant net selling by foreign investors since the beginning of the year. Although foreign capital only accounts for about 10 to 15% of the total capital in the market, these selling waves have negatively impacted investor sentiment. The new circular issued by the State Securities Commission is a crucial step in removing obstacles to upgrading the Vietnamese stock market to an emerging market, thereby promoting foreign capital inflows and improving market liquidity. However, systemic risks will also increase. Securities companies may be exposed to payment risks. If many foreign investors fail to make timely payments, securities companies may be forced to sell pledged securities, creating significant selling pressure, increasing price volatility, and negatively impacting market stability. The above information provides an overview of the circular amendment aimed at removing pre-funding requirements for foreign institutional investors. Interested investors should contact us for the latest updates on investment and the stock market. We wish all investors happiness and successful in life.